This afternoon, the Reserve Bank of Australia announced its June interest rate decision, and for the first time in 4 months, they didn't raise rates. The cash rate stays at 4.35%, no increase, no decrease, a hold. After 3 consecutive rate rises this year in February, March, and May, the RBA has pressed pause. And for millions of Australians managing mortgage repayments that have climbed sharply this year, that is genuinely welcome news. Not a fix, not a rate cut, but breathing space. Today we're breaking down what today's decision means, why the RBA chose to hold, and what comes next. Let's quickly recap where we are. The RBA began raising rates again in early 2026, reversing the 3 cuts it made in 2025. The reason was clear: inflation came back. The Iran war and the Strait of Hormuz disruption pushed fuel prices to record highs, which fed through into almost every other price in the economy. By April 2026, underlying inflation was running at 4.2%, well above the RBA's 2 to 3% target. The RBA responded by raising rates 3 times. Each time, the major banks passed the increases straight through to mortgage holders within days. From nearly zero in late 2020, the cash rate has now risen to 4.35%, the highest it has been since 2011. Millions of Australians on variable rate mortgages have seen their monthly repayments increase by $1,000 or more compared to 3 years ago. Today, for the first time since January, those repayments are not going up again. So why did the RBA hold today rather than raise again? The statement from Governor Michelle Bullock gave several reasons. First, there are signs that the economy is slowing. Consumer spending has weakened. Business confidence has fallen. The unemployment rate, while still relatively low at 4.3%, is starting to rise. These are signals that the previous 3 rate rises are working, that borrowing is becoming more expensive and people are spending less. The RBA wants to see whether that momentum continues before tightening further. Second, inflation, while still too high, has shown some signs of stabilizing. The April monthly CPI figure of 4.2% was actually slightly lower than the March figure. 1 month does not make a trend, but it was enough to suggest the worst of the inflation surge may be passing. Third, the Iran situation has evolved. A fragile ceasefire is holding. Oil prices have come down from their peak. The fuel price shock that was the biggest single driver of the 2026 inflation spike appears to be easing, though slowly, and with significant uncertainty about whether the ceasefire will hold. Fourth, and the RBA was explicit about this, the board wants to assess the cumulative impact of the 3 rate rises it has already delivered before deciding whether more are needed. 3 rises in 4 months is a significant tightening. The full economic effect of those rises hasn't yet worked its way through the system. The RBA is pressing pause to see what happens. Governor Bullock used the phrase space to assess. The board, she said, now has some space to observe how the economy responds before making its next move. That is careful, cautious language. It is not a signal that rate cuts are coming, but it is a signal that the tightening cycle may be nearing its end. The major banks' economists have updated their forecasts following today's decision. Commonwealth Bank and Westpac now both have the cash rate peaking at 4.35%, the current level, meaning they're predicting no more hikes. The first rate cut, on current forecasts from both banks, is expected in either late 2026 or early 2027, depending on how quickly inflation returns to the target band. ANZ is slightly more cautious, saying 1 more rate rise in August remains possible. If the June quarter inflation data due in late July comes in higher than expected, that's the next key date for mortgage holders to watch: July 30th, when the June quarter CPI figures are released. If they're higher than forecast, August becomes a live meeting. If they're in line with or below expectations, a hold in August looks likely, and cuts could come into view by the end of the year. What does today's hold actually mean for you? If you're on a variable rate mortgage, your repayments don't change today. That's the immediate practical impact. The repayment you made last month is the same repayment you'll make next month. After months of increases, that stability, however temporary, matters. If you're trying to decide whether to fix your rate, today's decision doesn't resolve that question. Fixed rates are priced by the market on future expectations, not the current cash rate. If markets believe the cash rate has peaked at 4.35% and will start falling in late 2026 or early 2027, fixed rates may already be pricing in some of that expected decline. Talk to a mortgage broker before making that decision. The right answer depends entirely on your circumstances. If you're a renter, the hold doesn't change your situation directly, but if the rate cycle really has peaked, the flow-through effect, landlords facing higher mortgage costs and passing them on through rent increases, should start to ease over time. Not immediately, but the direction changes. If you're saving, the news is more mixed. High-interest savings accounts and term deposits had been offering attractive rates while the cash rate was rising. If the RBA has peaked, Those rates may start to drift down from here, though the timing will depend on what the banks choose to do. Here's the bigger picture that today's decision fits into. Australia has been living through the most rapid tightening cycle since the early 1990s, from near zero rates in 2020 to 4.35% in 2026, a swing of more than 4 percentage points in a few years. The impact on household finances has been enormous. 3 million Australian mortgage holders have seen their repayments increase by hundreds of dollars a month. Renters have faced record prices as landlords pass through their own higher costs. Consumer confidence has been weak. Economic growth has slowed. Today's hold is a tentative signal that the worst of the tightening may be over. It is not a turn in the road. The RBA has made very clear that it will raise again if inflation requires it. But for the first time since January, the board has decided to wait and see rather than move again. That's not much, but for millions of Australians whose budgets have been stretched to breaking point, not going up is something. Are you watching the RBA decisions closely right now? Has the rate cycle affected your financial decisions this year? Drop it in the comments. I want to know how this is landing for people in different situations. Like and subscribe for more Australian news explained simply. See you next time.